If you follow the world of tech and infrastructure, you know that massive AI demand has triggered this just seismic frenzy
Yeah,
of data center investment. I mean, it's global.
it's everywhere.
Exactly. New facilities are being planned, built
Yeah.
at a pace that's just dizzying. But when you look at the news, all the analysis, it feels like it boils down to this really frustrating binary choice.
Right.
Is it this runaway success, a guaranteed boom for the next decade, or is it a massive bubble that's about to collapse?
And that binary choice is precisely what the sources we've been looking at tell us we have to move beyond. I mean, the system is just too complex for these simple success or failure labels.
Right.
The intelligence we have introduces a framework they're calling the Structural Desynchronization Watch, or SDW.
Right.
So our mission in this deep dive, it isn't to declare if the DC market is winning or losing.
Right.
Our goal is to observe the synchronization state of this whole investment structure, to identify the specific type of friction that's happening between all its moving parts. We're looking for tension, not, some inevitable outcome.
That is such a crucial distinction. It's like we're treating this whole thing like a complex machine. We're not judging if the machine is good or bad, but just asking, are its parts working together smoothly?
That's a great way to put it.
So today, we're going to look at why DC investment can't be framed as simple success or failure, what this structural misalignment actually is, and we need to get specific on that mechanism. And then we'll see what the latest observations from late 2025 tell us about the adjustments that are already happening.
Let's start with that core concept.
Yeah.
SDW is necessary because really, at its heart, DC investment is running on two fundamentally different timescales. They're in the same universe, but they are operating at wildly divergent speeds.
Okay, so tell us about these layers that are creating the friction. I've heard them called the fast layer and the slow layer.
Yeah, think of it as the ultimate speed mismatch. The fast layer is made up of all the high-speed elements. These are driven by competition, by algorithms, by capital. So this includes the AI competition itself, which needs compute now. It includes rapid capital movement, quick decision-making by hyperscalers trying to lock down land and capacity. And this is a crucial investment commitment.
The willingness to just write the check.
The willingness to immediately write a check for a multi-billion-dollar project. This layer moves at the speed of an algorithm making a trade.
It's the intent, the desire, the money. It's the promise of
the future, exactly. And then you have the reality check, the slow layer.
Right.
This layer is all the processes that are constrained by physics, by geology, by institutions. This is the heavy stuff.
Okay.
Power infrastructure development, the literal construction timelines. How fast does cement actually cure getting grid connection and system connection approved by utility companies? All the regulatory factors, permitting, and maybe the heaviest piece of all, the long-term recovery model.
The recovery model. Now, for listeners who don't spend their lives reading financial reports, we mentioned the recovery model. What are we really talking about?
We're talking about the time it takes to make that initial massive investment profitable. In finance, it's often tied to something called the internal rate of return, or IRR.
Okay.
So when you sink billions into a data center that's designed to operate for 20 years, you need a very specific multi-year timeline for that cash to flow back to you. The slow layer moves at the speed of bureaucracy, environmental impact studies, and, laying high-voltage cable in the ground.
So the core issue here is that the capital and the AI demand are running a 100-meter dash, while the utility company and the construction crew are running a multi-year marathon.
That is the perfect analogy. The core issue isn't excess capital, and it's not fake demand. It is the structural non-synchronization between these two layers. And this is where that term gradient comes in.
Right. We flagged gradient as a piece of jargon we needed to define. What is it in this context?
So think of the gradient like the friction and heat you get when two gears are supposed to mesh smoothly, but they're spinning at completely different rates.
Okay.
The fast layer gear capital is trying to spin at, say, 1,000 RPM, but the slow layer gear, the power grid, can only manage 100 RPM. The gradient is the objective measurement of that friction. It's how much the fast layer is slipping against the constraints of the slow layer.
And the SDW framework is designed specifically to observe that slippage.
Yes. It doesn't predict success or failure. It observes the gradient and then the resulting quality of the adjustment. It's designed to identify the types of ways things might break, not whether they will break for sure, so that investors and planners can see what kind of structural revisions are needed.
That structural view is incredibly valuable because it just bypasses all the emotional hype. But before we get into the actual observation logs from late 2025, let's talk about how this kind of observation is even possible. You mentioned this underlying methodology called mini-fields. For you, the learner, how do we stop the analysis from just getting swept up in the latest CEO soundbite?
This is a critical point, and it's why mini fields emphasizes structure over just, impression. Let's imagine we're reading a quote from the CEO of a major power company, and he's promising vast new capacity within 2 years.
A quote that would make headlines, "Send infrastructure stocks soaring."
Precisely. So the mini fields framework has 3 core rules for processing that information. First, core field A, structure over impression. We avoid judging if that CEO's statement is right or suspicious.
Okay.
Instead, we extract the underlying structure. We ask, what is the CEO's objective function? A utility CEO's objective is to maximize long-term grid stability and regulatory compliance.
Not necessarily maximizing the stock price or selling the absolute maximum amount of power tomorrow.
Exactly. So that statement gets filtered through that structural lens. Even if they promise speed, their core objective dictates that their execution must prioritize safety and long-term stability, which inherently means slow.
And if that CEO delivers the statement with a lot of confidence, that brings us to the second rule, core field B, emotion as gradient. We don't just filter out their enthusiasm as bias.
Right. We treat that emotional intensity as a sensor. If the CEO sounds incredibly optimistic about the next 2 years, that optimism is a signpost. It tells us where the pressure, the gradient, is most concentrated.
So the pressure to reassure markets and regulators that they can actually meet this crazy demand from the fast layer.
Exactly. Their optimism is a measurement of the tension that they're trying to absorb.
We're basically turning emotion into data about the pressure cooker underneath. And finally, because we're talking about the future, we have core field C, plausibility over certainty.
Yes, we have to avoid 100% judgments. We categorize that CEO's 2-year prediction based on its plausibility. If that same 2-year timeline is mentioned by hyperscalers, by construction firms, by geopolitical analysts, all working from different playbooks, we label it high plausibility.
But if it's only mentioned by the CEO and it's contradicted by, say, the Utility Commission's own filing timelines,
we label it low plausibility. It's a measure of consensus and structural consistency, not some kind of absolute truth.
that's a really sophisticated way to filter the signal from the noise. So let's apply this. Let's look at the monthly log from December 2025. This monthly rhythm, as the sources note, it's strictly about sensing, right? You're just trying to catch the early signs. What did the framework sense in December?
The overall assessment for December was a cautious attention flag. There was no clear systemic breakdown, no catastrophic signs. The interpretation was that the friction in the slow layer is being locally sensed, but the market hasn't fully internalized it yet.
It's like hearing a small creak in a huge ship.
That's a good way to put it.
Okay, let's look at the specific detection points. First, the big fear. Completed but low operation data centers, the so-called unused DCs. Is capacity just piling up unused?
The finding here was classified as minor. We did not see evidence of a large-scale, massive increase in completed but unused DCs globally. That would suggest, a collapsed demand scenario.
Okay, so that's not happening.
No. But what was detected were scattered, localized signs of postponed ramp-ups, and some construction plans being delayed by a quarter or two.
So the assets aren't stranded, they're just stuck in traffic.
Precisely. They're waiting at the traffic light of the slow layer. This tells us the gradient is causing slowdowns, but not outright failure.
And what about the critical components inside? The GPUs, the AI equipment itself? I mean, if DC construction is slowing, that super expensive hardware should be backing up in warehouses, right?
You'd think so, but surprisingly, the finding was no change. There was no visible buildup in warehouses or large-scale resales of critical equipment.
That's a huge signal.
It's a vital structural signal. Securing that equipment is still the dominant pressure across the industry. The market is still trying to ensure supply. It's a fight for GPUs, not dealing with an excess inventory. That tells you the demand from the fast layer is unequivocally real.
So the fast layer is still accelerating hard, but the physical constraints of the slow layer are acting like a parachute. Where is that constraint most visible?
It's overwhelmingly concentrated in the power connection observation. The finding there was also minor in December, but the key structural signal is the permanence of the problem. Long-term waiting periods for high-voltage power connection are mentioned continuously across multiple regions. This isn't a temporary hiccup.
This is a new fact of life.
It is now a fundamental structural constraint on growth, no matter how much capital you have.
So the monthly log suggests the investor stance is more of a time axis adjustment of their plans, not a strategic withdrawal. Investment doesn't stop, it just gets penciled in for a later date.
That's the key takeaway from the sensing stage. It's a localized, persistent friction that's forcing internal planning revisions, but it hasn't, metastasized into panic or market withdrawal.
Okay, so now we move from that monthly sensing to the deeper quarterly view. The quarterly phase shifts into structural evaluation. It's about stepping back, assessing the larger trends, looking at all of Q4 2025. What was the structural conclusion?
The evaluation moved beyond just sensing to a clear conclusion. Adjustment. The sources are explicit here. The DC investment phase is now defined by an asymmetry between the high-speed capital and the low-speed physical infrastructure. And crucially, they emphasize this is not structural runaway, and it's not total collapse. It's a necessary structural correction.
So what was the concrete evidence that locked in that adjustment classification? I want to know how this actually hits the finances.
Well, there were three major pieces of evidence. First, on the unused DC accumulation. While massive plant capacity continues, the core constraint is that power grid connection is actively limiting construction speed.
Oh.
The only reason we aren't seeing a massive glut of unused DCs is that the slow layer is literally throttling the building process itself. The potential for that pileup is extremely high, but the physical bottleneck of the grid is constraining its manifestation.
So the system is almost self-regulating its own imbalance, just because the physical world can only move so fast.
Exactly. The supply chain for power transformers, switchgear, permits. That is the true governor on construction speed. Second, look at the GPU and AI operation premise. Strong, real demand for compute exists. The fast layer's core promise is true.
What?
But the delays on the infrastructure side are fundamentally suppressing the speed of operational ramp-up. The AI model is ready to run, but the physical house isn't finished and powered up yet.
And that has to hit the bottom line. I mean, even if you don't cancel a project, a delay means your return on investment gets pushed way back.
And that leads directly to the third and maybe most financially significant piece of evidence. Quiet pressure on recovery models, IRR. While very few companies are making explicit public corrections to their IRR models,
Of course not.
the constraints around power and long lead time equipment are being recognized internally as new, permanent, long-term cost factors.
What does that actually look like on the ground? Are we talking about CFOs just quietly updating their spreadsheets, or is it more visible?
It's mostly quiet internal revisions. For a hyperscaler, if they planned on a 5-year recovery timeline, and the utility tells them the power connection will now take 3 years instead of 1, they have a 2-year operational delay baked in right away.
Wow.
This quietly increases their cost of capital and extends the time to profitability. We're seeing contractual language change to allocate risk for utility delays. We're seeing internal forecasting metrics shift the expected ramp-up curves for new facilities. The capital is still committed, but the expectation of time is being permanently revised. This quiet pressure is the clearest sign of this adjustment phase.
Okay, so synthesizing this whole Q4 picture. The fast layer, the capital, the will to invest is holding strong because the demand is real. But the slow layer, the physical reality of power and construction, is establishing a hard ceiling on the speed of growth. The investment doesn't stop, but the time assumption adjustment has become a permanent feature of the entire industry.
That is the core takeaway. The market is delayed, not strategically withdrawn. The expectation that the slow layer will just magically accelerate to meet the fast layer, that's being revised downward by necessity.
So this deep dive into the SDW framework, it gives you a powerful non-binary tool to think about friction in a multi-layered world. Why should you, the learner, care about this specific structural log? Because this non-synchronization, it continuously applies pressure to the foundational recovery models and operating assumptions across the entire AI ecosystem. This affects every major tech company and investor.
We really established the SDW-0 thesis. We are not observing structural runaway or total failure, but an initial explicit structure of adjustment. It's a structurally non-synchronized state. So the immediate question this picture now opens for the next phase, SDW-1, is whether this adjustment, this friction will remain, absorbable by the market, or if the delay will escalate.
Escalate into what?
Escalate into a desynchronization that forces a complete public rewrite of the fundamental recovery assumptions across the entire industry.
That is the critical escalation point. So what should we, the listeners, be watching for in the coming months? Where is the answer to that fundamental question going to appear first?
The answer is going to manifest in 3 core measurable areas. So you should keep your eye on. First, the actual accumulation of unused DCs. If that power constraint suddenly breaks, the floodgates open, and we see massive unused capacity, that's a red flag.
Okay.
Second, The real-world trajectory of power connection waiting periods. Are they stable or are they extending even further? And third, the performance of actual versus expected operational utilization rates. The size and the consistency of that gap is the clearest sign of the structural shear between the promise and the physical reality.